Hi everyone, I'm Keith Sprauer, Chief Investment Officer for Global Wealth Advisors. Today I'd like to take some time to review the markets and discuss our outlook for the third quarter of 2023. As we move past the first half of the year, we can look at what's happened and where we feel we are given the current market environment. There continues to be very different views on what are the important data points and what direction the economy and the markets will be going. So let's begin with performance for the first half of the year. As we look at the familiar performance quilt, we can see on the right the year-to-date or YTD numbers. The developed equity markets continue to impress. Through the end of June, U.S. large cap was up about 17%, and large cap international was up about 12%. And you can see as we move down the column that asset allocation or balanced accounts are up around 8%. And so on until you get to the negative broad asset class shown here, which is commodities. Down about 8%, keeping in mind that last year commodities ended up at the top of that list being up a little bit over 16%. And this is very driven by supply chain functionality and global aggregate demand. You can also see that fixed income markets are beginning to stabilize after last year's historically poor performance due to the aggressive rate hikes from the Federal Reserve. Through the first half of the year, though, fixed income is now up a few percent. Given the equity performance and the increase in what we have seen in the interest rate environment, we feel it was a good time to rebalance portfolios back to their targets, which we did. It's not always good enough to just say that performance numbers are good or bad, but you need to look into how you got there. This is a very interesting and telling graph. And what we're looking at is year-to-date performance attribution breakdown of the S&P 500. And it breaks performance attribution into two pieces. The first is 8 stocks. You can see by the list there, it's Facebook, Apple, Amazon, Netflix, Google, Microsoft, NVIDIA, and Tesla, which are the rust-shaded areas on the graph. The gray area is the other 492 S&P 500 stocks. So it becomes very apparent that about 80% of the year-to-date performance is coming from a handful of stocks. We're starting to see that change a bit as investors are shifting some money into higher quality stocks. But the takeaway is that if the economy is functioning well, you should see a broader group of stocks and sectors doing well, not just 8 or 10 out of 500 stocks. And without belaboring the point, another way to look at this is to plot the S&P 500, which is a market capitalization weighted index. Bigger companies are more impactful, versus an index that equally weights all the stocks in the S&P 500. Here I'm using the RSP, which is the Invesco S&P 500 equally weighted index. That's in blue. And you can see from the blue line that when you make the proportion even, the year-to-date performance is much lower than the capitalization weighted S&P 500. You can also see from the timeline that the performance separation of the two happened around the time of two major events: the banking crisis scare and the increased talk of generative AI. When we're making decisions around asset classes to purchase, there are many inputs, and one of them is relative value. I feel this slide opens up the door to show some of the opportunities that we're seeing in investing and putting cash into the markets. It's a bit busy and gives a lot of information about historic returns, year-to-date returns for different market capitalizations, and different styles are shown here. I would point to the year-to-date data in the boxes at the top right of the main graph. And what we're looking at here is the performance of small, mid, and large cap for value, blend, and growth styles. When you take a step back and look from a high level, it becomes apparent that a performance box like this can help to identify relative value trades. If we look here and you take the extremes, small cap value has returned 2.5% year to date versus large cap growth, which has returned 29%. Now that's more than a 10-fold performance difference. Looking at the group to the left, the 10-year annualized numbers show that large cap growth has only been double small cap value historically. And even though small cap tends to work better coming out of recessions, given the likely lower borrowing rate environment and increased economic activity around small companies, we feel the current valuations are attractive enough to add to small cap value here, which we did. Over the next few slides, we'll take a look at the Federal Reserve's own projections from their June meeting. And though everything is subject to change, we're at a point where the information is a helpful input. So they decided to pause at this meeting, but came out and said they would expect to raise rates another 50 basis points by the end of the year. They don't know at which meeting, and they may be more data dependent. If they go one more time in July, currently the market expects this to happen with a high probability, mostly due to the strength in the labor market, or two more times before the end of the year, which would bring them to a Fed funds rate of 5.5 to 7.75%. The real takeaway is that they are at the end of a historic time in Federal Reserve history. Their bigger economic summary and projection page shows us that the expectation is for a moderating economy, increasing unemployment, and moderating inflation numbers over the next 6 months or so. I think it's interesting that from the time you get through the next year, you're very close to their longer run averages. It's also good to see that when we look at the next few years, those bottom lines on the chart of the Fed funds rate projections are moving lower, including 100 basis points or 1% of rate cuts by the end of next year. We know that those lower rates will help the economy and the markets over time. It's very important to keep in mind that this is data that uses the median as a measure of central tendency. So there is a disparity among voting Fed members. You can see in the group titled Range, the 2024 federal funds rate projections go from about 3.5% to 6%. And that means someone feels they are going to need to hike more than is expected, and someone feels they need to cut more than is expected. But even though there are a range of outcomes, I do think you can still use the median data as a framework to build out economic scenarios. The overwhelming focus of the markets has been on global central banks and how they are addressing their country's position in their economic cycle. Here in the U.S., it's been about the Federal Reserve's formal mandates of reasonable inflation, somewhere around 2% in their minds, and keeping at full employment, meaning keeping the unemployment rate as low as economically feasible. We can start to break these down by looking at the updated data, starting with the Fed's favorite inflation measure, the personal consumption expenditure, or the PCE. We can see that whether it's the headline or the core PCE, though not at the target, they're continuing to drop significantly. This is even more apparent in the CPI data. You can see from the left-hand side of this graph that year over year we've seen a healthy adjustment from a headline peak of over 9% to currently around 3%. 3% is the lowest reading since March of 2021, with the core CPI having moved down to about a 490, which is the lowest reading since October of 2021. It hasn't been quick, but it has been steady. And unlike the S&P data we looked at earlier, which is very concentrated, the inflation move down over that year has been across many areas, though differing in degree. One of the areas that has been resilient is the shelter component of CPI. Shelter has been a sticking point in the deflationary process. The latest data point for shelter and CPI was a year-over-year number of 7.8%, and you can see this from the red line on the graph. You can also see that it is down slightly from the recent peak a few months ago of an 8.2. It's important to note that, as we have spoken about in the past, leading indicators, leading economic indicators, in this case, shelter is a lagging indicator. As you can see, rents have already moved lower, but the shelter portion of CPI is just starting to turn down. Over the next few months, when we look at a year-over-year CPI, we should see numbers drop off more. Switching gears to the other Fed mandate, jobs, we're starting to see some softening of the labor markets. They are still very strong, but we've seen the ability for wages to come down and the unemployment rate to increase over the past few months. This strength should keep the Fed on track to hike in July, but a continued moderation combined with the lower inflation should keep the hikes from continuing. And this is part of the reason why I feel a recession will be mild and not long-lasting. And that's the fact that we're quickly moving towards an ideal, for lack of a better word, of a range regarding the two mandates of the Fed. This next graph shows the increase in mortgage rates, particularly the 30-year fixed rate mortgages, over the past few years. And you can see that we remain at the top end of the range. Initially, I felt that persistent high mortgage rates would put downward pressure on the housing market from a lack of demand. But supply has also been restricted because current homeowners don't want to move from their current monthly payment to what could be a much higher monthly payment. One of the consequences of this is that housing prices are still robust and affordability has dropped. As we may have spoken about in the past, it's very helpful when a big part of the population can take part in home ownership. There's a sense of pride of being part of a community. They tend to want to do more upkeep than as a renter, say, and people feel like they have roots in an area. And this is a classic part of a functioning economy and societal equality to a certain extent. I saw a recent example that looked at monthly payments when 30-year fixed mortgages were around 3% versus holding that payment static in today's mortgage rate environment. And the results were that purchasing power for this particular data was decreased by 31%. So a lot of people have either gotten boxed out of buying their first home or moving to a new home. To close out this quarter's talk, I put together a few items that I feel are hurting or helping the markets along. And I've broken them up into headwinds and tailwinds. I'm going to touch on a few from each. On the headwind side, even though I didn't focus on them earlier, there are still economic data points that are pointing to a recession, like the leading economic indicators specifically, and all of its components, like the shape of the yield curve and the Institute for Supply Management data, and so on. And even though the Federal Reserve is coming to an end of their cycle, above average rates could be with us for a while. And that doesn't help the cost of capital for companies or affordability in housing or to move the economy forward. One item that's been a constant throughout the hiking cycle is the fact that the Federal Reserve continues to shrink its balance sheet by letting securities mature without repurchasing anything new. The balance sheet is somewhere around $8.5 trillion in assets. They're letting about $95 billion of mostly treasuries and mortgage-backed securities roll off each month. Not a big dent, but it's additive to the tightening cycle. On the tailwind side, we absolutely needed to see inflation come down to be in any position to see our way forward, and we have. And with that, interest rates will eventually decline. Investors will become even more comfortable with moving out of cash and into equity and fixed income markets. And the last point to make around the tailwinds is more of a clarification around the line item about government action during the recent banking issues. We saw the Treasury, the FDIC, and the Federal Reserve working together to ensure this didn't become a systemic issue. And that's good, even though they said after the great financial crisis they won't do it again for institutions not of a certain importance, again, for lack of a better word. I put this in as a tailwind, something that's helpful in resolving certain black swan events, and I believe it to be the case in the shorter term. I do feel there is a longer term danger to picking and choosing which bank survives and which don't, which customers will get their money back during a bank run and which won't. I've always felt that having small, medium, and large banks help to solidify the system across the country, but I don't know what the unintended consequences will be as we seemingly move through banking consolidation and to an oligopoly in the banking sector. So more to come on that. From everyone here at GWA, thanks for watching, and I'll speak with you next quarter.